Good morning. It's Wednesday, the 5th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. What a nail-biter that was, at least in the context of expectations. The BJP or the Bharatiya Janata Party was not poised to win overnight an absolute majority, which is 272 seats of its own in a 543-seat lower house of parliament, as it desired, and now has to work with a coalition. Now, there is no shortage of political analysis on what led to the BJP's reduced majority, but there are a few lessons from a stock market's perspective. First, the exit polls that were released on the 1st of June, Saturday evening, were wildly off the mark, and the disappointment for many was the reversal of the build-up caused by those exit polls, which came in 2 days before the markets opened. That's on Monday, the 3rd of June, rather than the actual disappointment in BJP's performance, which was, of course, high. Now, exit polls as a device, which has very little or almost nothing to offer apart from driving gladiatorial viewership for television stations, must now be scrutinized and ideally discarded in their current form. Second, as we've been repeatedly saying here, politicians should not talk up the markets and stay away from making predictions or outright exhorting investors to put their money in. Now, this has never ended well and ended quite disastrously this time. Add to this the phenomenon of Modi stocks, which some brokerages started compiling, which was distasteful and highly condescending to companies and their business leaderships. Yes, the markets could well recover from the 6% or so fall on Tuesday, but the damage is done. And let this be a lesson that markets will do better if left alone rather than openly guided. The market is a very intelligent being collectively than many give credit for, and more have learned the hard way. And now to the top stories and themes of the day, and we are largely focused on two issues, equities and oil, as we have several viewpoints to showcase as well. The stock markets fall close to 6% as the BJP is forced into a coalition to govern its next term. Why did the markets fall so much, and what stocks led those falls? As markets look beyond the Modi stocks, what are the new investment themes going forward? Oil prices are still falling, which is good news for India. What is driving it, and how long could it remain low?
This is a core report with Govindraj Ethiraj.
The markets fall over 6%. So the stock markets were primed and tuned, as we've been reporting in the last few months, for a BJP-led majority. Now that has not happened. As we've also pointed out, the markets were going to express their disappointment even if the BJP or NDA, which is the collective coalition, was slightly short of its targets and not completely off, as is the case today. Seen from that perspective, it's actually not that bad, at least the market's reaction. Because the fact is that the NDA government will continue, at least as things stand at this point. I hesitate to use words like bloodbath in the context of stock markets, but Monday, the 4th of June, would surely qualify as such. The BSE Sensex crashed over 6,200 points intraday before settling about 4,390 points, or 5.7% lower at 72,079 levels. The Nifty 50, meanwhile, broke the 22,000 mark to hit an intraday low of 21,281. It ended down 21,885. That was down 1,379 points, or about 5.9%. In the broader markets, the BSE MidCap and SmallCap indices sank up to 12% before settling up to 8% lower, which is what most small investors would have seen in their portfolios. So therefore, stay calm. Not all stocks were down. Consumer products stocks like HUL or Hindustan Unilever and liquor company United Spirits rose 6 and 5% roughly in a crashing market. The thinking is that the government will now spend more to keep the electorate happy and place more money in their wallets. I'm not sure it will provide subsidized liquor though. The brokerages have warned that a derating is in the offing for Dalal Street, and the high-flying Modi stocks could face a reality check, according to the Economic Times. Global brokerage firm UBS said that this was not an election outcome the market valuations were set up for. India valuations have been expensive for ordinary corporate earnings growth and outlook. One of the arguments behind India's rich valuations could have been the political stability, policy certainty that a strong government gave. And some of these assumptions could come under question, which is, of course, quite obvious. But in some ways, this is very good news because the correction that has set in is always good, or in general, any such correction that's a correction to overvaluations is good for the markets. So I spoke to two market veterans from a slightly different point of view for each of them. I first reached out to Deven Choksey, Managing Director of DRChoksey FinServ, and I began by asking him how he was seeing the outcome of the elections from a stock market point of view, which was, as I indicated, primed and projecting a NDA absolute victory.
Well, I believe that I think the narrative of growth probably hasn't worked in the hinterland of the country, wherein I think the caste politics has ruled significantly, as can be seen from the vote swing, which is there in the UP and the rural Maharashtra. So that is probably, I think, the key takeaway as far as I think the whole outcome is concerned. Of course, I think the numbers of NDA definitely, I think, is something which one has never anticipated. Probably, I think it is a disappointment of large to a larger extent. But all said and done, we'll have to wait and see how the government equation gets played out, because it is very clear and obvious at this point of time that whatever it may be, it will be a coalition government of NDA. If at all, I think this is going to be the way in which the numbers are being seen currently. So from that perspective, I think we'll have to wait and see what exactly comes out of the discussions, meetings, etc. But overall, from the corporate side of the activity and the economic side of the activity, I believe that majority changes are not likely to take place. Economy is basically on a path of growth, and that is continuing. Save and accept the situation wherein the government may have to alter some part of their allocation policy. Whoever the government gets into, they should not be altering to the allocation policy. If that does not happen, then the growth business continues in the economy, and so would be the growth continuing into the corporate sector. So from that perspective, things don't change materially overnight, but at the same time, we'll have to wait and see.
So one question that people, I'm sure, will ask on, let's say, Wednesday morning, that's today, is there a likelihood of the market falling further, or was this the worst reaction that we could have seen till now?
So let me put it in numbers. I think today, if you observe the index fall, 68% of the fall has been led by 8 stocks, out of which I think one is Reliance, 2 of them are Adani Group stocks, Adani Port, Adani Enterprise. 4 of them are BFSI stocks, ICICI Banks, SBI, Bajaj Finance, and HDFC Bank. And one of them, the capital goods one, which is Larsen. So frankly speaking, I think these stocks have given 68% fall to the indices today. Now, if you look at the fundamental aspects of these companies, all these 8 companies, nothing changes. Frankly speaking, I think the business of this company remains as it is, as robust as it can be. Maybe the government policy was helping them a lot, but at the same time, these companies have their own ability to run the businesses in a systematic manner. So from that perspective, I think we remain distinctly positive that the market would once again go back to quality. Earlier, the narrative was lost. Earlier, the narrative was on momentum side. So frankly, quality was ignored. Now the quality is once again going to be asked for, and that will be asked in the portfolio. So such names which I spelled out, I think they would be the ones we would probably once again be asked by the investor in their portfolios.
Right. And speaking of narratives, one of the narratives obviously was public sector stocks. And we also saw a lot of that getting hammered on Tuesday. And then we had sectors like defense and again, banks, but state-owned banks. So do you see that changing at all? Because that even most institutional investors I've been talking to were warning about overvaluations in these areas.
One is overvaluation and second is sustainability of that valuation. I think this is something which one has to be talked about, I think, in detail. Many of the public sector companies, including public sector banks, they have the fantastic business models. I think there is no question asked about it. Second most important question I think one should be asking in a given situation, whether there will be a sustainability of the leadership in the public sector undertakings. If that situation compromises and if the management or the leaders get shifted from one end to another end the way they were being done in earlier years, after this government came in, I think they will stabilize on that front. If that thing has to start once again back, then probably it's a fear that I think the PSU, PSBs, whatever we call it as, I think they will probably have tough time going forward, because sustainability of funding is extremely important. This government has given maximum thrust to these companies by way of giving them a business, at the same time profitable business. That has to continue in whichever way any government comes into power.
So that's on the fundamental side. But on valuations, your sense is that we were mostly valued fairly in these areas, particularly PSUs and defense?
Yes, absolutely. I think in some cases, premium valuations of FY27 were given to those companies based on the growth that they reported. So certainly, I think it's a question that whether this valuation will come back immediately. Answer is probably no. Maybe it will take a while before it gets reconciled.
Right. And when you look ahead, Deven, what are the two or three things that give you confidence? I mean, you said, of course, that the macro story is steady, which it is. When you look at from a company point of view, either companies or sectors, what are the ones that you really are, let's say, invested in and will continue to be invested in as themes?
As long as infrastructure spending in the country continues, as long as industry focus continues with the PLI schemes and the other growth programs, I don't think that anything is materially changing as far as I think the companies and their prospects are concerned. The government will have to stay more focused on giving these companies maximum amount of time to build their business model for next 20-25 years. So nothing should be done in a short change manner. Like for example, today the PLI schemes are in operation. Tomorrow, anybody coming in and start tweaking those PLI schemes in the name of I think labor, accommodation, etc. Those kind of stupid stuff should not happen. That is what I think one would expect. As long as I think nobody makes such kind of silly mistakes, I would think that I think the situations don't change. The companies would continue to perform, and maybe I think some amount of momentum-based valuation which went into those companies may get corrected, but fundamental part of the valuation will remain intact. That is what my view.
So obviously, we saw a 6-7% drop in the benchmark indices on Tuesday. What's the normal time that these things take to recover and get back from past experience?
So good question, Govind. I think 2019 we have observed this situation wherein the India VIX touched 30 during this particular poll outcome period and the week in that particular which the outcome came in. Subsequently, in following 3 weeks, I think the VIX came down to 15. Till yesterday, India VIX was 20. Today, it jumped up to 27, 28. My understanding is that I think given the kind of volatility that is getting now subsided, the euphoric condition is now getting probably settled. Then in such situation, I think the VIX should go back to 12s and 14s, not I think at the level of 20s and 30s. So given that volatility getting subsided, maybe I think in subsequent months from now on, the more meaningful addition into the portfolio will start happening based on the fundamentals of the company.
Deven, thank you so much for joining me.
My pleasure. Thank you so much.
Even as the NDA returns to power with current Prime Minister Narendra Modi set to take a third term, the composition of the government, thanks to allies coming in, is bound to shift. The changed composition could also mean some changed priorities. Will Modi stocks still hold forth? What about public sector units, defense and stocks linked to capital investment? Yes, and I don't like the term Modi stocks, but I'm using it because it's being used. Now, much of this may not change, but the sentiment driving those prices up obviously has taken a hard knock. In which case, what are the new themes one can or should explore? After all, markets don't dwell too long on the past. I reached out to Dipen Mehta, founder director at Elixir Equities, and I began by asking him what were the new themes that he was thinking of at this point and how he was looking at the market ahead.
All that I can say is that I think that certainly the stocks which did well until the 3rd of June may not do well going forward. So the way I look at it is that this particular phase of the bull market, which started post-COVID, I think ended yesterday. And the stocks that did well for the last 4 years, the PSU stocks, the cyclicals, the industrials, sure, they'll continue to do well. And you will see very good earnings also flowing through from those sectors. But the damage will be on the valuation part. The street will not pay the same high level of price to earnings multiple for those cyclical businesses, for those industrial and commodity type businesses. And there will be definitely a shift toward defense. And investors, anyway, over the last 2-3 years, 4 years, have been underweight defensive stocks. So they'll scurry to kind of, balance their portfolio in such a way that in the event of there being constant political stress or some sort of political turmoil, their portfolios are protected in that way. So there will be definitely a shift towards defensives. And we'll get into which sectors I think are defensive. But by and large, I think that we are entering into a new era. And all through my growing up years, I've lived with coalition governments and always, felt very stressed about it. And unfortunately, now again, after 10 years of peace, we have to deal with this new animal, or rather the old animal in a new avatar.
Okay. So now a couple of questions. So let's come to defenses, which you referred to. So what could be the defenses? Because again, I guess it links to valuations. Most of the defensive stocks, let's say some of the banks or IT services companies and so on, they were doing well and they continue to do well, but their valuations have obviously been beaten down. So how could that change and why should it change?
See, I think if you see the trading pattern, a lot of investors thought that FMCG was the defensive sector, and it sure is. And one of the things in favor of FMCG is that now maybe the government will follow more populist policies and it'll give more direct money in the hands of the people, so consumption will go up. Sure, I agree with that. But a lot of the FMCG categories have reached very high levels of maturity in urban markets and rural markets. And, the volumes are similarly low, 2 to 4% or so. Even if it goes up marginally because of higher spending power, it's not going to be really attractive, considering that the valuations are also pretty much stretched over there. And gradually, raw material prices also are going up. So I'm not that enthused about FMCG stocks. In my opinion, the ultimate defensive sector has to be first is pharmaceuticals and next is IT services companies. And from that point of view, we would like to gradually raise our exposure to pharma stocks. We have seen last 2-3 quarters, the pharma companies have delivered very good numbers. There is less competitive intensity in the US generics market. Overall compliance with US FDA also has improved, so that risk is gradually has receded a little bit. And globally also, I think a lot of intros have been made by Indian pharma companies, a lot of which are driven by very aggressive entrepreneurs, and they have made their mark in the global market. So that's one sector we're looking at being overweight in. And then, of course, there's the software. But software, it's a bit of a patient waiting game because the exact quarter in which US tech spend will start to look up is very difficult to get a handle on. And I know that artificial intelligence and cloud are great, I would say, triggers for increasing tech spending, but we have to yet to see that at ground level. But what is also positive is that the IT companies are sitting on very good order book or contract position. So once there is some certainty in US economy and tech spend start to pick up, then execution also will pick up for these companies. So basically, I'm creating a defensive strategy around these two segments, pharma and IT. And also, I feel that banking shares should also continue to do well because the whole economy will continue to do as it has been doing. I don't see any major issues over there. But the thing about banking is that banking and NBFC, they are overall sector. Everybody's got them in their portfolio. And they're a large part of the market capitalization. So I would rate them to be at best market performers. But the outperforming sectors could be pharma and IT as I discussed.
Right. So you talked about this. I mean, the way you interestingly defined it is that this was a 4-year bull run of sorts, which has ended, in your words. Now, one of the things that drove this was obviously domestic fund flows, including a lot of retail investors coming in directly as well as through mutual funds. Now, how do you see that class of investors behaving or acting? And how do you see even, let's say, the institutions who represent those investors moving here on?
Yeah, Govind, that's a very perplexing question and a very serious one because the investors who entered the market after COVID, they haven't seen a bear market. After 2004, this is the first time I've seen a market like this, which has corrected as much on account of a political fallout. And these new generation investors haven't even seen how coalitions work. Because now what will happen is that every statement made by every regional party, you will have to take cognizance of. And I'm very skeptical and very nervous how the actual constitution of the cabinet will look also because the biggest disappointment for the market, and that means that its flexibility and its leverage is considerably reduced and it will have to make concessions to its partners in the NDA. And although they are strong partners and they have reposed faith, but their bargaining power goes up. There's no two ways about that. And we have seen these coalitions in the 1990s and the 2000s, even in the first UPA, how they actually play out. So I'm a bit nervous, cautious on that count. And clearly, this is the time when the conviction of the average Indian investor, the household, will get tested. whether they still believe in the India story, whether they're still prepared to wait it out when they see actual negative returns in their SIPs. That needs to be seen. And Govind, there's one very important observation is that a lot of the money which has been invested by the households in SIP on the same families, the same couples, they also have EMI commitments. So on one hand, you're investing in SIPs because the markets are booming. You're engaging in options trading, day trading because you see short-term opportunities there. On the other hand, you are sitting on loans because if you have seen household loans have skyrocketed, especially personal loans and loans for appliances and digital products. So a lot of the future expense of these households are being funded through loans. At the same time, they are doing SIP also. So it's like, how average household family doing like an arbitrage where they are borrowing on EMIs and trying to invest in the stock market. So this entire equation will get tested. And I hope that we don't have reduction in the SIPs and lower mutual fund flows. Because if that happens, then, we'll be in for deeper corrections. Because at the end of the day, as I said today, the way I look at it, this market is not about fundamentals. This market, next few months, weeks, months, quarters, will work on liquidity flows and the technicals. And both of those are on shaky ground.
Right. Last question, Dipen. So this was, let's say, the bad news. If there was good news in terms of how you feel, or rather what you feel are the silver linings in all of this, again, from a pure stock theme and identification point of view, what would it be?
No, the only silver lining going is that at least, we were, the NDA was able to get to around 290. 10 seats less and there would have been even more mayhem. So I don't see any silver lining in this thing. I think that we have to brace ourselves for a few tough months. Markets may do well. I could be wrong. I reserve the right to be wrong, as I would say. But I don't get comfort. And one of the reasons for that also, Govind, is the valuations. Any company you see 50 times, 60 times, 70 times, good businesses would like to be invested in, but they're going at valuations which I have never ever bought in the past. And, that's really the serious problem here that, these valuations to get into a situation where there is so much of political uncertainty, where the political uncertainty can lead to economic uncertainty. In any case, there are geopolitical events, commodity prices are going up, US elections are there. There are so many moving parts and we don't have certainty. You can pay high P multiple when there's certainty, but I'm not prepared to pay high P multiple when there's uncertainty. So, in my opinion, the defining trend for the next year will be that corporate profits will come through, but we will see sharp contraction in P multiples. It means stock prices can correct or go nowhere, but the corporate reserves are pretty much fine.
Dipen, thank you so much for joining me.
Thank you.
Oil prices fall further. Good news. Oil futures fell further on Tuesday following OPEC Plus's, or the Organization of Petroleum Exporting Countries Plus, plan to return barrels to the market earlier than expected, raising concerns that the market will be oversupplied, Bloomberg reported, and something that we discussed on the core report yesterday as well. Brent crude fell as much as 2% to about $77 a barrel now, compounding losses from the previous day. The OPEC Plus alliance is scheduled to start unwinding output cuts as early as October. Obviously, all of this is unexpected. Some market watchers had expected OPEC Plus to extend cuts through to the end of the year. So there will be more supply in a not-so-certain demand scenario. I reached out to Viktor Katona, lead crude analyst at Vienna-based energy intelligence firm Kpler, to understand why oil prices were falling and what his outlook was for the coming year.
The market's reaction to the OPEC Plus meeting, which, a lot of people expected that the messaging that OPEC would send into the markets would be different. Because ultimately what they've said is, we're going to bring back supply. We're going to produce more, not now in the summer of 2024. It's still going to be the same, but we're really looking into 2025, and 2025 will see higher supply. And that has, I think, scared a lot of investors who thought that basically OPEC Plus would just stay where it is for a much, much longer time. And effectively, we have seen the reaction. More supply into 2025, and people just exit their contracts, and a little bit of a panic ensues. I don't think it's going to be a longer playing story. It's going to be a story literally just for the next couple of days. But still, it's it's quite sizable. We're for the first time Brent is below 80 since February. So that's important.
And what's driving the likelihood of a production hike?
Well, it's really the understanding of OPEC Plus that if they don't bring back production in 2025, they're not going to have that many opportunities over the next years in 26, 27, 28. Because right now what we have is we have a little bit of a gap in non-OPEC supply. U.S. production is stagnating. Guyana doesn't have a single FPSO coming online this year, so Guyana doesn't have any incremental production either. Brazil has been underperforming and isn't really having a massive 2024. Guyana, Brazil, these guys will have a very strong second half of 2025. So basically, if OPEC doesn't bring back production now, someone will take that place. Someone will occupy that spot. And effectively, prices would stay the same, but there would be limited opportunities for them to come back. So it's better to do now, better to suffer, an oil price of 75 or whatever ensues. And ultimately, then just enjoy, much, much more supply. Less suffering for Saudi Arabia, which, the fiscal deficit of Saudi Arabia has been getting quite tangible. So they need more volume. They need more production. Even if it's at the lower price, they just need that.
So would you say that in the sort of contest of who blinks first, OPEC has blinked this time?
Absolutely. I mean, OPEC is playing a little bit of a different game than the market is, right? Because the market is really looking into the short term. OPEC is looking into the long-term fundamentals. One of the key things I think of the OPEC Plus meeting in Riyadh is that the OPEC Plus member countries have effectively said, we're going to stay in here controlling the market or controlling this, basically the marginal barrel of supply for the next years. Because, every single meeting, people come up with speculations about, will the UAE break off? Will the UAE finally say no to Saudi Arabia and OPEC Plus in general? And this is a very solid claim. They are saying, yes, we can accommodate growing pains. We can grow as an entity and basically will control the market. So in a sense, they have blinked first, but also they have maintained the cohesion and the unity within the organization, which might be even more important for Saudi Arabia in general, because this is a long-term project.
And at this point of time, how much of global crude production does OPEC Plus represent?
I mean, effectively, OPEC Plus represents roughly a third of global production. So it's quite a lot. What's perhaps even more important, OPEC Plus countries are generally net exporters. So they don't really refine that much. They control a lot of the crude exports. The seaborne movement of oil flows, there they have a much bigger proportion of everything. So basically, the control is there. They have been losing that control, I would say, when the US had this massive increase in production. Everyone was, talking about non-OPEC supply. By now, that has tapered off. And I think right now, we're heading into a period, let's say in 2024, 25, 26, when oil prices will not be 100. I don't think they will be 100 at any point over the next 2 years. But I think that oil prices will be relatively stagnant. So basically what OPEC does is it prevents a market collapse by being basically the marginal provider into the market.
Right. What's your sense right now on the demand side, Victor? I mean, and how is that likely to influence prices in the near term?
Again, I think the market's understanding of where demand is a much more realistic understanding than OPEC oftentimes projects into the market, because OPEC still maintains its demand forecast of 2.25 million barrels per day, which I think is very ambitious and very optimistic. Generally, the market consensus should be somewhere around 1.2, 1.4 million. That's what the market kind of agrees on most of the time. What does this mean? I mean, it means that Europe is stagnating, marginally declining. The United States is stagnating, marginally declining in the future as well. And it's really Asia that's the driver. In Asia, China is enjoying the last couple of years growth before it starts to stagnate. And then it's other guys taking over. India has been absolutely the driver of demand growth this year. I mean, the performance of the Indian oil industry has been nothing but stellar. But it's not only India, it's also other Southeast Asia countries, which are growing with tremendous pace. So basically, Asia is really where demand growth is. I think in general, looking into the future, the demand growth that we're going to have over the next couple of years will be much lower than we've been used to, simply because effectively we just have one continent that's still growing. Everyone else is off. The post-pandemic recovery, when everyone was rebounding from the COVID slump, that's over. We just have one continent, that's Asia. Asia is where the strength is.
What's your outlook given all of this for prices and specifically in the next few months?
Well, I think that the summer would have some recovery to the upside. The summer looks tight. Basically, everyone will be coming back from refinery maintenance. We'll finally have mobility figures that we actually deserve, because the mobility figures of the past couple of months have been quite weak, frankly. We'll have a lot of tourism. We'll have a lot of jet fuel demand that will kick in. So I think the summer looks relatively healthy. I think Brent comes back to 80, 85. That's the range that it should be trading at. And beyond that, looking into the winter, I think the new norm should be this 75 to 85 range. The drops below 80, I think, will become much more frequent come winter than they will right now. This one is an emotional reaction. What we have seen yesterday, that's the emotional overreaction of people who got scared. But in the winter, the fundamentals would say, hey guys, it should be 75. It should be 80. We're no longer talking triple digit prices for a while.
Victor, thank you so much for joining me.
Thank you very much for having me.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.